If you own investment real estate and you sell it, there's a good chance you could owe capital gains taxes on that profit. But what if there were a legal strategy that allowed you to defer those taxes and reinvest the full proceeds into another property? That strategy is called a 1031 exchange, and it's one of the most powerful wealth building tools in real estate. Today, I'm going to explain 1031 exchanges in simple terms so you can understand how they work and whether they may be useful in your long-term real estate investment strategy. My name is Joe Luca, Realtor, and my goal with this channel is to help buyers, sellers, and investors make smart real estate decisions that lead to the best possible outcomes. Okay, so a 1031 exchange is a provision in the Internal Revenue Code, Section 1031, that allows an investor to sell one investment property and invest the proceeds into another like-kind property while deferring the capital gains taxes. So in simple terms, instead of selling an investment property, paying taxes on the capital gain, and then investing what's left, a 1031 exchange allows you to reinvest the full proceeds, the full value of the property, into another investment property. This can help investors grow their portfolio much faster, increase cash flow, upgrade to larger properties, and diversify investments. And because the taxes are deferred rather than eliminated, investors can continue compounding the real estate wealth. One of the most common misunderstandings is the phrase like kind. It does not mean the properties have to be identical. For example, you could exchange a rental house for a multifamily property, or a multifamily building for a commercial property, or a commercial property for vacant investment land. As long as the properties are held for investment or business purposes, they generally qualify as like-kind real estate. However, personal residences do not qualify for 1031 exchanges. Now, there are two critical deadlines that come with 1031 exchanges. There are two things you have to pay attention to. Number one, the 45-day identification period. Within 45 days of selling property number one, the investor must identify the replacement property or properties. So you could sell one property and buy two other properties as like-kind properties or more. And then there's a 180-day closing period. The investor must complete the purchase of the replacement property or properties within 180 days. Because of these deadlines, it's extremely important to work with a qualified intermediary and experienced real estate and legal professionals who understand the process. Many real estate investors use 1031 exchanges as part of a long-term wealth building strategy. It can allow them to trade smaller properties for larger ones, make investments into stronger markets, improve cash flow, or consolidate or diversify their portfolio. Over time, this strategy allows investors to scale their real estate investments while deferring taxes along the way. In many cases, this dramatically accelerates long-term wealth building through real estate. So a 1031 exchange can be an incredibly powerful strategy, but it's also a process that needs to be structured properly. If you're thinking about selling an investment property, even if it's your first one, a 2 or 3 family home that you don't live in, and want to explore whether a 1031 exchange strategy makes sense for you, it's important to speak with qualified professionals before you sell. If you found this video helpful, please make sure to subscribe to the channel, like the video, and share it with anyone interested in real estate investing and wealth building. I'm Joe Luca, Realtor, and my mission is to help people make informed real estate decisions that creates better financial outcomes. Thanks so much for watching. Take care. Bye-bye.